We do.
I think we should turn it on while we're doing all that stuff. Shows our
We are live.
Okay, we're live. Good morning, everybody. I'm sure there's going to be a huge audience here today, so this is going to be a good time. We've got a special guest. Chris has joined us. Chris Delaney, the mortgage messiah, I guess is what we're
Mortgage
calling him.
Messiah.
You see,
Yeah,
he's got an
Mortgage
angelic,
Messiah.
he's got an angelic glow around his head, long hair. It looks like
Put him on a candle.
Yep. And we don't know what's going to come out of Cody's mouth today, so this is going to be interesting. But like we normally do, we're just sitting around the table talking like friends and talking about the business. Does anybody want to throw out any topics? Greg, I know you've usually got some good topics, or do you want me to kick it off?
I don't know if you guys heard, but the loan limits increased this week. Has anyone heard that?
That only took 2 minutes or a minute for that to come
I
up.
actually remember seeing one post about it, and it really stood out to me. It was like a graphic that had like the new loan limits, and it really spoke to me.
I sent you that meme I made last night.
I know you did. That was pretty funny.
I was very proud of it.
That was pretty good.
Brian, what were the loan limits when you started?
400. No, I think 265 rings a bell. Wow. So I started in 1996.
Wow, in the 1900s.
I know. I actually did the math the other day. I finally did the math on how many years I've been in the industry. It's 27 years. For a long time, I didn't do the math because I didn't want to know.
I was 2 years old.
Thanks, Cody.
Wow.
You're welcome.
I feel like mortgage years are like dog years, though. For every 1 year in mortgage, it's the equivalent of 7 years in most other careers. You know what I mean? So, like, I'm like 84 years in with that math. So, where are you at?
I'm 189 years. I get my calculator.
Ouch.
Who's the Messiah now?
Great point.
Yep. That was definitely BC. Definitely BC.
Yep. Before Chris?
I don't have the angelic glow, so I can't take that no matter
I'll start off with a legitimate question. Since we do have the chart guru on here today, I was trying to think of something that started with an M, but I couldn't do it. Yeah. So, no, you're bad. So what do you think, as far as the loan limits and stuff are concerned, obviously there wasn't that much appreciation this year, in the last 12 months, for the most part, everything was kind of flat. So like, what's your take on, or first of all, how do they decide for the loan limits? Like, how do they determine that? First of all, I'm sure you probably know. And then why do you think they did it way more than anticipated, way more than everybody anticipated?
This is for me, right?
Yes.
Yes.
Everybody else.
I don't know that it was more than everybody anticipated. I think it's more or less in line with where people thought. I mean, normally it's about 3%, so I think it might be a little bit over 3%, but that's why initially, they were coming out not letting people do 750 up to 750, right? Because that's under 3% from where they were. They look at, the impacts of inflation, right? Everything's getting more expensive. Incomes are rising. And with that, you have home values going up. And they didn't go up a ton this year, but I think the rates were more or less in line with historical averages. It's not 20% like we saw, a couple of years ago. So I think that the adjustments were more or less in line with what I thought they were going to be, just based on how much they typically increase them. Mm-hmm. So I wouldn't say it's too far-fetched that they were going to raise them as much as they did.
Like you see all these people talking about, I don't know if it's just to have some talking point. I'm really not sure. I haven't paid that much attention to it.
A lot of people talk to have talking points.
Yeah, a lot of talking points, a lot of noise. But you hear people say, "Oh, well, this means they believe in the housing market." Does that play a factor into the loan limits? Do you know that?
I don't, but I'll ask the older folks on the call here. Have they ever decreased the loan limits?
No.
No.
No, I just pulled up a chart because I was curious about what the loan limits were when I started in the industry.
246.
207. 207 in 1996. They went to 214 the year after, then 227. They've never. I'm seeing the historical historical increases. Never ever have they decreased them.
What
There
did
was
it
a
do
period.
in 2008?
So they stayed flat for an extended period of time.
Mm-hmm.
In 2000, starting in 2006, they went to 417, stayed at 417 until
I remember
2016.
Yeah.
And now they've gone
You're
up.
muted, Cody.
Oh. Did you say in 2006
760.
they went down?
No.
They
No,
stayed
in
at
2006 they
417
went
for
up
about 10 years.
to 417, and then stayed flat until 2016. So stayed flat for 10 years, which they've never done.
So
yeah, I think if you just look at at home values over time, they've only, in the long run gone up. Incomes have increased, maybe not along at the pace that they should. So I think it's only natural that they're going to increase those loan limits. What's the average, not the median home price, what's the average home price these days? It's like in the 4s.
Yeah.
So I think that's the way they look at it is, again, it's average, or even if they're looking at median, right? It's the median is the middle number. Average is the average number of what people are paying. Half are paying over, half are paying under. Right. And median is just a series of numbers. So they have to figure, all right, we've got a bunch of people on this side and we've got a bunch of people on this side. Our job is to make home ownership attainable, obviously with meeting qualification parameters. So we have to open up, that higher half or part of it to allow those people to get conventional mortgages. And let's face it, I mean, it's not like Fannie Mae is a nonprofit company, and I know the FHFA is who oversees them and Freddie, but
right.
I read somewhere that Fannie Mae is the most profitable company in the world.
Mm-hmm.
So
I believe that.
I believe it.
I mean,
believe
they're a
it.
business,
Mm-hmm.
even if they are a government sponsored entity, it's a business.
Mm-hmm.
So kind of where I was going with that, just the last piece here is you are super in tune with the markets is basically what I was getting at. You're super in tune with the market.
Not as much lately as I would like to be, but yes, I try to be.
You're pretty dang into it. Where do you feel like, because most loan officers, if we're being honest, half of them don't know what a bond is or treasury is. Where do you feel like that gives you like an advantage or an upper hand when it comes to, knowing that above most loan officers?
Well, I think it's easier to have maybe a longer term picture. Because, if you just think about cycles in the market or, we're both in Dan's group, he talks about market breadth all the time. You can see these cycles play out. And, when something gets overbought or oversold, that's when you tend to start looking for reversals. And, bonds, I mean, nobody really talks about how the bond market crashed and it's massively oversold and bonds are at a value. And so at some point, and who knows, maybe we're starting to see some of it now. I was scrolling through, I guess it's called X now, this morning. I didn't have much time, but there were a couple of people commenting on it and some short covering on bonds and things like that. When they're massively oversold like that, eventually the big money is going to start looking towards the value that is in those very low prices, right? And people understand that bonds and rates are typically referred to as yields, have an inverse relationship in price to yield, which means when the prices go down, the yield goes up, and yield is rate. And so when you see bond prices as low as they are, and they're you can get them cheap, all things considered right now. eventually the big money is going to start moving that direction, especially when things start to crack economically. You know, like if war breaks out or the unemployment continues to rise, which is the Fed's goal at the end of the day. They're going to start looking to that. And as they start to buy more of those bonds, that's then going to drive the prices up, drive rates down. And then, you know, if something really does break and the Fed comes in and they cut rates, so the mechanism at which they alter those Fed funds rates is also through the purchase and sale of securities and treasuries, or I'm sorry, bonds and treasuries, and their balance sheet. And so if the Fed comes in and starts buying bonds, then the big money is going to also then come in and buy more, because now you have, you know, essentially one of the biggest buyers of bonds buying more bonds. So they're going to say, well, we need to buy in because they're going to buy more, and that's going to drive the price up. And it just increases the value of their portfolios, and they make money at the end of the day. That's what it is. Yeah. So that's a long way to answer your question. It is. So I think, you know, we're not seeing economic weakness as a whole. You're seeing it in some sectors here, some there. But I think it's going to happen. It's hard to say when, you know, but you just can't, if you're talking to like a client and stuff like that, you can't get them under this assumption that, yeah, listen, I know that this is tough for you to afford right now, but look, rates will go down and you'll refinance. You can't be doing that. It has to be,
date the rate. All you gotta do is date the rate. That's all you gotta do.
Well, we think this is what's going to happen. So be comfortable here. Yeah. If you're good here and you can refinance later, and let's say you lower your payments, great. That's a plus. Or maybe you cut the term, right? Yeah. And now we're at the same payment basically on a shorter term. Now you're saving money through interest. Yeah. You're building equity faster.
Yeah. So basically it just helps you build a strategy better than most, because you're not going and charging a bunch of points knowing that more than likely you're going to be calling them in a year and a half to 2 years.
Well, I you know, everybody's situation is different, and I always give people the options of points and show them what this looks like and how that looks, and you know, let them make a decision that's going to be best for them and what their plans are. But you know, I never try to get anybody under the assumption they're going to be able to refinance. You know, if people want to know, they want to get into it, I will. But also, if I get a contract and we need to lock, which I got to be honest, I don't think that I've floated anybody when they've gotten a contract for probably the last almost 2 years, and it's never backfired for the client.
Right.
And I have a closing this morning, and we locked in at the beginning of November, and I just floated her rate down it was over a quarter of a point. Mm-hmm. So those are things too that, you know, if you're paying attention and you're looking at the market, I don't need to go, I can look at the market and see, okay, we've moved this much. Yeah. So I know that a float down is going to be for sure. All I got to do is call, you know, marketing and ask them, you know, what the float down options are and get those. Mm-hmm. Yeah. So for sure. How that helps me, I guess that's how I use it.
Yep. Well, it helps the client. Ultimately, it's about helping the client, right?
Sure. Yep. Yeah. I mean, at the end of the day, that's what it is. And not, you know, listen, not every loan officer is going to be as interested in this stuff as I am. You know, and that's fine.
Jesse's like, I'm out.
But I think it's important.
Yeah.
I think it's important to have some kind of knowledge in this stuff. And there's a lot of resources out there that you can learn. Like if you go to mortgagenewsdaily.com, which is a great informational website. I forget where it is. It's somewhere in their website, but they actually have a 4-page article about mortgage-backed securities.
Mm-hmm. That's where I learned about everything.
And it breaks it down very simply. And I think that's a great thing for loan officers to understand and people that are in this business. So you have some gauge of why rates do what they do. Because it's not, you know, I talk to clients all the time. It's not that the bank just opens up one day and says, well, we think our rates are going to be this.
Yep.
Sure, there are some banks that do that depending on the product, or they have investors or that back those products, whatever the case. But, when we're talking, most conventional products, FHA, VA, a lot of that stuff is dictated by, mortgage-backed securities in the markets.
And it has more to do. It has more to do with the Fed offloading their balance sheets with all that supply in the market more than it does.
I'm going to throw my opinion out on the Fed right now.
Yes,
I think that they started too late and they were too aggressive. They should have started
as per usual.
They should have started probably 6 months ago because they knew it was coming, and they should have started 6 months ago. And it should have been. I don't know that wherever we're at 5.5% right now is not where, I'm not saying that's not where we should be, but we could have got there at a easier pace because it takes time to get down to, Main Street. It takes time to work its way through, anywhere from 9 months to a year, typically, for that to be felt on the ground floor. And we're not at that point yet. And it will get there. And you watch, they will start cutting rates before unemployment peaks. It happens.
It happens every time. Yep.
Every time.
Yep.
So when they start cutting, what's coming. Now, I don't think we're going to have, 10% unemployment or anything like that. But I mean, it could be wrong. I hope I hope that
history usually repeats itself, though. The cycles are usually pretty true.
I think it'll probably get a little bit higher than they expected, but and hopefully it's mild if that is the case and people get back on their feet quickly.
Yep, absolutely.
So you brought up a great point a minute ago, Chris, which is, you feel, and I agree, that most loan officers really don't understand this to a high degree. But I also think there are a few people on the other end of the spectrum, they play junior bond trader and try to get their best client the best rate in the short term based on market conditions, which I also think is a mistake. Not a current company, but a prior company that I worked for. We had a loan officer talk to one of his clients, super upset because the loan officer told the client rates are going to go down next week. When the unemployment numbers release, rates are going to go down next week. So let's float you now, and then we'll lock you in next week when rates went down. When rates go down, guess what happened? Rates spiked. So the client was super upset because the rate was now 0.3% higher than the initial quote, because they were expecting something lower than the initial quote.
That loan officer deserved that, though.
So this is
it was going to take an extreme like that to get him to quit doing it.
Yes, and he did.
Sure. Yeah, there's you and I, Brian, were talking about it the other week about the over-analyzation of the data.
Yes.
Just the asses and elbows, if you will, like a roofer, and paying a little less attention to what's going on and just doing the work a little more. Absolutely, a lot of those people. As I catch myself being one of them quite frequently and have to pull the reins back a little bit.
Yep.
That's a trauma response, though.
It is.
I'm kidding, but not really. Like, that's truly, like, if you've been in the industry prior to the past couple of years or 18 months specifically, like when things are chaotic, I think just as humans and like your lizard brain thing, right? Like it creates a certain fight or flight thing. You're like seeking answers. The whole prefrontal cortex shuts down. The amygdala is running the show, and you're like, data. Barry said this. Uncle Barry says May 10th. So like, that kind of thing. So I do think it's a little bit of a trauma response, because if you have been in those positions and, we are looked to as someone who can offer guidance. So it's like I don't want to say you. For me, I'm like, I want to know all the things that I can possibly share. And my job is to give you as much information with which you can then make a decision that works for your situation. But it's difficult to toe the line. So I read, it was on one of the forums that I'm sure we're all part of, or Facebook groups or something. last year, and someone said the best lock advice I ever got was from retired fighter jet pilot. And he said, it's better to be on the ground wishing you were in the air than to be in the air wishing you were on the ground. And I'm like, that's such an easy way to relay that to any client or to any other LO who's like, oh man, we're just going to float. I mean, like the chances of it working out, if a client demands a float, like that's one thing, but the chances of it working out, I mean, and you know, even on a short-term contract, 30 days, if you lock, in most cases, the rates aren't going to improve so much.
And,
you might miss out on
think about that conversation. Just think about that conversation, though. It's like, you know, if you have to renegotiate with a borrower, okay, like they're not pissed off at you because you were protecting them,
right? Yeah.
You know what I mean? And you can always take it somewhere else. But
here's the other part of the equation in a situation like that. So I agree with you. I mean, even within a 45-day window, it's probably not going to change that much, right? Or even day to day, like, oh, let's float it to tomorrow. It's probably, even if it does improve, it probably won't be 0.1%, right? That's pretty rare. But if it is, great. But here's the thing about being on the broker side that I love, because you can show clients it's a win-win for them. So number one, obviously, is a rate renegotiation or float down. Pretty much every lender has that, whether they're retail or broker or whatever. There are different requirements depending on the lender and investor, whoever. But the option we have as a broker, and I've done this many times, and while sometimes it's a pain in the ass for processing, is, you know, like just before this last CPI, you know, the night before, I locked in 2 people and I told them, listen, this is happening tomorrow. It can go either way when these reports come out. So let's protect ourselves. And if tomorrow it's better and I've got another bank we're partnered with that has better rates, we can just go move the file, you know, with your authorization, we can move the file, lock in that rate and move forward. And we still have the option of a float down. And depending on how far out their closing is, you know, again, because we're partnered with multiple banks, if something happens in the next week or 2 weeks, we could do that same thing again. You know, but you obviously can't do that at the last minute, right? Because it's got to be underwritten and you got to get into closing. But
I do think that's one of the. Oh, sorry. Go ahead.
I was just going to say, I've explained that to so many clients, and they say, "What's the downside?" It sounds like there is none.
And there is none, right?
And yeah, it's a little more paperwork to set up a new file and move everything over. It's not that big of a deal. You know, at the end of the day, they're going to be thrilled.
That's actually, you brought up a really good point that I wanted to talk about the other day, but I forgot about it. I remember, but right before I switched to broker and retail, whenever something like that would happen, like they keep tabs on your rate renegotiations. Like the lock desk manager keeps tabs. You know what I mean? And so all you're doing is trying to take care of your client, do your fiduciary responsibility, yet you're getting killed off on the back end by management and CEOs and all these people, and you're getting docked for it, and you're considered a, you know, not as profitable loan officer. You know, because they all measure those things, and you only get so many rate renegotiations, whereas like on the broker side, you switch it to another lender.
Jesse, you're smiling.
That's because it's more, you know, they're thinking it from the standpoint of company profit, not looking at it from the customer's point of view. It's like we're on the street talking to the client that's looking at the fact that they can save tens of thousands of dollars on interest. Or what are we going to do?
Thousands of dollars on points.
Yep.
Well, to me, it's like a moral thing. It's like the customer is paying me. Without the customer, I don't make the money. So I shouldn't be working for the company. I should be working for the customer.
It's a fiduciary responsibility at that point, 100%. And you bringing
so you're stuck in the middle and pulling from both sides.
But the morality factor, at the risk of sounding extreme, is why I'm on the broker side now.
Yep.
Well, it's about emotional selling.
I love it. Let's hear it.
Right? It's emotional selling.
It's emotional, but then I just feel like, and I've described this to a lot of my partners, it feels more in line with my personal integrity. And maybe that's not for everybody. And maybe,
Mhm.
you know, maybe other folks don't evaluate it the same way, or maybe it's a lack of understanding around like what's actually happening on the back end, or how much meat is on the bone for those that aren't, you know, involved in. Anyways,
We'll call
so
it non-producing roles. Non-producing roles.
Yeah.
So anyways, it feels, it just, that's probably been the biggest shift for me energetically in terms of how I feel going about my business on a day-to-day basis. It's like that whole, it's an integrity thing. I don't know how else to describe it, but like when you say like there's a moral component to it, I think there really is.
Yeah, absolutely is. I after our live the other day, I had a friend of mine that's a retail LO. He's a very big producing retail LO. He's he's in a small market and he's about 150 million a year of personal production. Like he's pretty big.
Is he the only loan officer in that town?
No, he's not. He's just
bigger markets, right?
He's just
it takes you.
I just mean like lower price point markets. I meant.
Sure.
But he saw that live video and he got not agitated, but he just called me and he's like, and he made some good points about, like talking about, hashtag brokers are better. He's like, it just agitates me. He goes, because it's not broker versus retail. He goes, it's all of us versus the greedy middleman.
Mm-hmm.
Like, just because you're a grinding retail LO doesn't mean that you're like, not as good of a person. That's not what that means. But as we were talking, I found out there was a lot of things he did not understand about the broker model.
Yes.
And I think that's so true of a lot of people on that side of the business, myself included, who was in retail for 25 plus years. There's a lot of things I didn't understand until I really met.
He asked me a very valid question as well. He goes, okay, if that's the case, then why? He goes, why do the biggest producers work for retail companies? And as we sat there and we dissected it, at the end of the day, you probably can do a smidge more volume with with the retail model because you're paying for all the overhead, right? But so is the customer. So we both had the same concept and the same idea, but we were thinking of it from two different sides of it. You know what I mean?
Mm-hmm. Mm-hmm.
So instead of saving the customer money, he's like, hey, I can do more volume. He might not make as many basis points or whatever, but he could do more volume and have a bigger team. But he can only serve these clients at a certain level because the overhead expense.
So it'd be interesting to really look at that, because I know for a fact there are dozens, probably hundreds of people on the wholesale channel that are doing 100 million a year plus. Like, it can easily be done. Not easily, but it can be done. Doing that kind of volume is not easy anywhere. But I wonder if there's this notion that all the big producers are on the retail side because there's just more people on the resale side, head count per head count. And now what you're also seeing is more people moving to the broker channel, which to me tells me there's a lot of validity in what this channel provides. And I would say, this channel's for everybody, or everybody should just be broker, or, I mean, there's certainly room for both sides. But when you really look at the math, and as I'm doing price comparisons with loan officers every day, we get on the screen or we get on a Zoom, we both share our screens. There's no smoke and mirrors. It's just compared side by side. The only time where they were a better price than us was when I was talking to an inside loan officer who had a very different compensation plan.
Yeah.
Right. It was an inside loan officer that had
$25 a file.
No, they were getting paid. I can't remember the exact number, but it was much less than what people on our channel or retail get paid. Much less. But it's, I think it can be done. I just think there's more of them.
Yeah. And I definitely think it can be done, but just like thinking in terms of why they're able to do it right now, it's because, like, you think about it, if I walked into here as a broker shop right now and I did all those loans, well, one of two things is going to happen. I'm going to have to hire a huge team, to help me. Or if you go to retail, they already have the team. So it's already in the margin. You know what I mean? That's the reason that they do it. Because they're paying for all that staff.
So let me challenge you on that a little bit,
Okay.
because we actually talked to, not challenge you, but just the flip side of that is,
you're not gonna hurt my feelings, Brian.
I know. That's what I love about you, jerk. We were talking to a large group on the West Coast, right, Craig? And we went to one of our wholesale partners and said, if we bring on this group, and it could be, 40, 50, could be 80 people at a time. If we brought in this large group, would you be able to help us with the transition? And the answer was unequivocally yes. So they would allow us to go to their corporate office, sit in their training rooms, leverage their trainers, their processors, to get them up and running for a week. Like the resources, we might not have the staff right here in Chicago in the main office, but we've got partnerships with some amazing companies that would have helped us with the same thing. So,
right.
Just to make the point that if we hired $100 million a year producer, we could do the same thing in a heartbeat.
Yeah. So let me ask you this follow-up question to that.
Sure. Sure.
When it comes to margin on the loan, when you're talking about these retail companies, they're making 400 to 500 bips, and that's not even including what they're making on the hedge, right?
Mm-hmm.
So they could potentially make 6 to 650 on a loan.
Mm-hmm.
And in the broker world, I know that non-deal is a little bit different, but in the broker world, it's max 275. Correct? Am I wrong about that?
Yes. Correct.
So, do you think that is potentially an issue down the road? I mean, because at the end of the day, there's, when it comes to the broker side, there's only so much piece of that pie.
Right.
So if you're starting to build a big team on the broker side, you can't build in all those margins. So is that something from is that why people call senators?
What, to get a bigger margin on the wholesale side?
But on a serious note, like legislation type stuff's gonna have to be passed, because there's got to be some middle ground there. You know what I'm saying? It can't go from 275 to 650. There's not really a bunch of middle ground there.
Mm-hmm.
So,
well, there's multiple factors in this. If you're talking about the retail side where they have the 650, you also have a lot of non-producing managers in between that are probably taking 300 of that, right?
Yep.
And then corporate's taking 125, which leaves then the LO, who is on a profit and loss, paying for anything and everything under the sun, that when it's all said and done, they're probably making net anywhere between 40 and 80 basis points, depending on maybe 100, 125, but a lot of it depends on their P&L, volume, overhead, etc. The same stuff happens on the broker side too, right? We're going to have X, and then we have our Y expenses, and then it turns into Z. And yes, you're playing with tighter margins on the broker side, but as I've told everybody here, volume cures everything, right?
Oh, absolutely.
When you're on the retail side, it's really about transactions and how much can we make per deal, because our rates are, anywhere between 1/4 and 3/4 of a point higher. And then you add on a couple points on top of that, because we have all the middle and layers of management that are non-producing. One of the things that when Brian came on, we made it very clear together that we were not going to hire non-producing people if possible, because we wanted to keep our margins as tight as possible in order to allow for more profit margin to come in that we could pass on to the LOs to the best of our ability. Because, here we run on very thin margins because we want to give the best of the best. We want to be able to pay our loan officers as much as we can, but we also need to keep the operation fully functional as well and provide the services as much as we can as well. And I feel like, with Brian, we've really tried to find that balance between retail and your mom and pop brokerage shop. And I think that's where, we've really hit the nail on the head when it comes to the structuring of our company. Now, let's go back a little bit further in our conversation from earlier today. We were talking about transactions versus relationships, right? We talked about emotional selling. We talked about, having integrity and trying to do our best to offer the best rates possible the first time, not the second, third, fourth, and then having to send the LE up, hope for a pricing concession, and then they come back and say, well, you can do it, but you're not going to make anything on the loan. It's going to come out of your pocket. What's wrong, Jess?
Not a thing.
But my point, though, is that we really try and do our best here, and relationship selling is going to help you grow your business so much faster. Organic selling is going to help you grow your business so much faster than just a transaction, right? I was running the numbers off of somebody yesterday, and I said, okay, well, let's say you do two loans at 250 basis points, or 3 loans at 6 loans at 200 basis points. And then those people refinance 3 times, and then those people refer you, 3 more people per transaction. It was a 3-to-1 ratio the entire time. And you were going to make more money by lower margins, but more volume.
So where did the 200 basis points come from? What do you mean 200 basis points?
If you're choosing a margin of 200 basis points to price your loans.
Okay, gotcha.
Yep. And I'd like to piggyback on something Craig was saying here too, which is, and Cody, you made the point that, retail, you're going to have a margin of 400, 500, 600 basis points. Remember, most of that goes to the corporate headquarters, right? The branch is not getting that. The branch is determining the pricing. And a branch could make, 250, maybe up to 350 basis points. And then that's how they build in their local branch expenses, is paid from that. But keep in mind, and so on the broker channel here, so over on our side, we're capped at 275. On the wholesale channel, remember, we also have a correspondent channel. So we can, in theory, then have more pricing and flexibility on margin as the situation needs. But we have to balance all of that with how aggressive do we want to be on pricing. And that was the point that Craig was just making, is I believe that.
Sorry about that. I lost you guys. So.
Oh, no problem. No problem.
We were talking about you, not to you.
We were talking about you now.
I figured.
Absolutely.
You're talking about my hair, damn it.
I was trying to turn my brightness down. There was a glare.
I figured. But go ahead, Brian. Go ahead.
Oh, but yeah, just to tie off on that, I think it's wise in most cases to take a reasonable margin, have an aggressive price, be known for having that aggressive price, because that's how you get referrals from, and of course doing a good job, but that's how you get referrals from friends and family and other realtor partners when you've got a great price and can capture business.
I would like to just add on to that. I want to go home at night being able to sleep knowing that I did my best, for that particular situation, for that specific client. There is nothing worse. I was in a shop a very, very, very long time ago, and I only lasted there 3 months because, the rates were through the roof, the title fees and all this other stuff were just crazy. And I'm just like, I can't do this. It's an emotional drain on me to try and offer these type of products, knowing that there was other better products out there. And like for those 3 months, it was just awful. I felt miserable. I didn't want to come into the office. I wasn't excited. I didn't feel like I was offering the best product possible. Brian, I mean, you felt that, and Jesse, I think you too, and Chris and Cody. Like, it's easy to wake up really, every single day knowing that, you have something that you can believe in, something that you are offering to your clients and to your referral partners that is something that sticks out, right? It's not like you're constantly, oh, I don't know if this is the best product, this, that, and the other. No, you believe in it. And so because you believe in it so much, it's easy for you to offer it to people. And I think that that's what we really try and do here is have our loan officers believe in the products that we're offering, because we know that they're really good. And it's about taking good care of the client in hopes that they take care of us and refer us 2 or 3 more people in the future.
Well, an elephant in the room, these conversations about pricing are completely forbidden in retail. Like, you don't talk about your rates, you don't talk about how much you make, you don't talk about what the margin is, like, don't discuss your compensation with another LO. Like, that's all very shrouded. So it was, I forget who I was talking to. I think it was my husband actually. And I was like, I was looking at this pricing on this 100% financing FHA. And he's like, wait, you can talk about that now? And I'm like, yeah, because we're all truly playing with the same deck of cards. And that's like, you can go to the, to the Facebook groups and see the same thing, which is a very different experience, because there's something that comes with that feeling of like not knowing if you're putting the best foot forward. You know what I mean? So it's refreshing to even be able to talk about pricing openly. And it's not about the comp piece of it as much as it is like, okay, here's the dollars that we have to sell to fund home purchases, and they are available at this rate, and let's find the best one for this program, etc.
One thing I was going to ask Brian, maybe this is a Chris question too, I don't know, whichever one of you wants to take it, or Craig. When it comes to the broker channel, one of the things that I've noticed personally, and that I've had a couple of retail friends of mine that have brought it up, just because I talk to them all the time about the differences, and just they're curious and stuff like that. And one of the things that one of them brought up that I just thought about the other day was a lot of these wholesale, a lot of people are shutting their wholesale departments down. So what does that look like from a sustainability standpoint of, there's a lot of people that have shut their doors over the last 12 months when it comes to the wholesale channel, right?
Yeah.
And I think, obviously it's not a super hot topic or anything. Nobody really wants to talk about it, but I do think it's not a concern, but something a lot of intelligent loan officers should think about.
I think it's a valid question. I don't know that I agree with you. I don't know if it's a concern, but it's a valid question. And here's what I'll say is, anytime there's a major contraction in any industry, multiple channels contract, right? Sure. And anytime there's a contraction in an industry, there are other channels and businesses that survive and thrive. So we've seen some of our bigger competitors, our larger competitors, that are originators, whether broker or correspondent, are losing loan officers left and right, and we're gaining loan officers. So we're so far, knock on wood, like we're on the receiving end of disruption.
Just because they hired you?
No, it's because of Chris. It's all Chris. Yep. So so the reality is there are going to be
that makes sense. And I think
and there are, if I could just one other quick point, and I'll stop talking, but I mean, there are retail lenders that
you're fine. It was cutting out on me. So that's the reason I.
Oh, okay. No problem. But there are retail lenders that are closing up now too. There are mortgage brokers that are closing up now too. Like, all channels are contracting.
Yeah. You mind if I toss in a couple words? All right. So our company's been open since 2005. And Cody, going back to you, like, we've seen it. We've seen it all. We've seen the implodometer. We've seen Citi exit the wholesale. We saw Wells. We saw all these companies exit, right? The problem is everybody gets this misconception that just because people are exiting the business doesn't mean that there's other new companies coming in, right? Because there's always going to be a shift, right? Shift in, shift out. Some companies are going to make it, some companies aren't. And as a broker, going back to Chris's point, we have options, right? We have options as far as the companies that are coming in, and we can work with them. And if another company comes in and they offer better products, well, now we have access to that. It takes less than a week to sign up with a different investor. And so with Chris's point, we have a bunch of options here. And even if a company goes out of business, okay, I'm really sorry, that sucks, but we have these other 20 different investors that we can work with and work with their products and services to still take good care of the clients. And since we've been open since 2005, we've seen 3, 4, housing corrections, if you want to call it. There was even a point in, we're based in Chicago, and obviously condos are, pretty relevant here, where Fannie Mae, Freddie Mac rolled out, you had to have 20% down to buy a condo on the broker side. We survived that. And so a lot of it really just comes down to having the options, having the availability, having the products, and being a legitimate broker shop. Because, if you're a legitimate broker shop, people want your business because there's less defaults, there's less EPOs, there's less of all the other crap that comes along with it. And, being a very reputable brokerage shop makes it so much easier to work with some of these other companies. And believe it or not, they have scorecards on us. And they can pull up the scorecard. They can see what we do, how we do it, what our average credit scores are, down payments, etc. And when you show them our scorecard, it's one of the best in the industry, in my opinion. And that makes it that much easier. But great question.
So just to touch on that, like that's pretty much the reason I came here. You know what I mean? Was because of that. Like these investors, essentially the way it's set up is they have VIP clients, they have A's, B's, and C's, and the VIPs get a smidge better pricing, a smidge better treatment, better turn times. Like you can call anybody any hours of the night. It's whereas in retail, it's like 4 o'clock rolls around, they're gonna hit that ignore button for a little while till tomorrow morning. And here it's like everybody's competing for your business at once. When you're a big company like you guys are and have a scorecard and long-standing relationships with investors, that's a good point.
Let's change the verbiage on that. It's we, not you, we. And then also, you have to remember that people want our business, right? Like I was just on the phone with an account executive late last night after 10:30, walking through a situation for a closing today. And the thing you have to remember is, on the retail side, they say that you don't have access to account executives, underwriters, anything like that after market. After 5 o'clock, forget it, right? But true. Here, we have amazing account executives, and that's because the Messiah over here continues to send really good business to people. And and everybody is like, oh, you work with Chris? Okay, great. I'll answer your phone call. But that's how it works. On the broker side is you have access to so many different things. I can't tell you how many times I pick up the phone and talk to an underwriter and say, okay, so here's the situation. Let's just call it what it is, right? We have this, we have this, we have that. What are your thoughts? How do we get this to work? Like there is
Brian, how many retail companies, Brian, do you know of from your recruiting that have actual underwriters that I'm not talking, I understand retail says in-house, but they're not really in-house. How many are actually in the building? None.
Yeah, very few. Very few.
And now it's the same concept, except for the underwriters working for you, and you have a full-time account executive, and their only job is to make sure the loan's closed.
Right. So either way, you're talking to a phone. It's a phone call away. Either way, it's
actually the complete opposite of what retail sells the LOs.
Yeah. Let me put it this way. The whole we have in-house underwriting. Well, at the end of the day, they all follow the same guidelines.
That's it. That's a great point too.
So unless they want to buy back,
nobody's going to book a loan
and that underwriter wants to put their name on the list. Like it's a dumb ploy.
Yep.
If I have a question for an underwriter, I pick up the phone and I call them, and I walk through a scenario with them. I mean, I'd say 99% of underwriters want to help you close the deal.
Yep.
So whether you're on the retail side and you have in-house underwriting, or you're on the broker side and it's through an investor, usually you're working with the same group on every loan. So they're already familiar with you and have a relationship with you. So it's the biggest farce when it comes to why retail's better. It's the biggest farce.
And I'm glad you said that, because you're a case in point that you can. And how long have you been here again? 8 years, right? 8 years.
8 years and a couple of weeks.
8 years and a couple of weeks, and you were new to the industry 8 years and a couple of weeks ago, and you're consistently now. Fast forward 8 years, you're consistently performing at a very high level in a tough market, and you're saying you don't have issue with access to underwriters.
No, and it also helps that. I made it a point to learn.
You're also good at what you do.
When I send in a file, obviously if it's a straightforward, I don't need to send any notes, right? But a deal where it's a little tricky and we have this going on and that going on, usually one of the things I will have processing upload is just I'll put together a Word document just explaining this is why I did this. we have this going on. We're renting this out, whatever the case is. So when they get the file, they're not like, how the hell did they put this together? Right. And then they're going to send it back and say it's denied or whatever. No, now they're going to see, okay, we're waiting for these things. This is why they did this. Obviously, if it's in accordance with the guidelines and everything like that. But it's just, that doesn't matter if it's in-house or not. Doesn't matter.
Right. You're right.
Right.
Sorry. It's just silly. Like, it just kills me when I hear people, work with a lender that's got in-house underwriting. It doesn't matter. It doesn't matter.
You have it even better. It's like my first company I did loans for, we had in-house underwriting. And yeah, I could go over there and sit on their desk until they answered me. But guess what? I also had other things to do during the day. Well, now I have somebody that can go sit on their desk all freaking day that don't have appointments.
The only time I would say in-house underwriting potentially could be a better situation is if you are producing at an extremely high level and you require a dedicated underwriter. That would be the only situation I could see that being better, right? Because that person's only working on your files.
Mm-hmm.
But for, the 99.9% of people, that doesn't matter.
No, does not matter at all. Jesse,
and with that 99.9% and all that, I'm just going to say the barrier to the top 1% is extremely low for being top 1%. Just throwing that out there. Because that kills me.
You mean all the posts?
Jesse, sorry guys. Jesse, we've been running some files and that kind of stuff. And, one of the biggest things that you've had access to, and I know you've commented on it, is the direct access to underwriting and being able to walk through files and walk through, basically some of them are complicated and, you've been able to have access to that. I mean, what has your experience been so far?
Well, I mean, just from a very top level, simplistic highlight reel, I had 2 loans that were not eligible for conventional financing that are now. I have a lender that's like standing on their head to help this client because it's going conventional versus FHA. It's better for their family, better for the nature of the property, better for all the things. And the AE was actually rerunning DU last night. Kendra called me at I think it was 7:45, and the AE had just called her and was like, it didn't work at 2 months reserves. Do you want me to try 6? And so she's literally sitting there trying to get it to the point of, massaging the numbers in a way that would ultimately best serve the client. So that's very different than suspending a loan because the appraised value was accidentally mistyped with a transposed number, which is a real life story.
I've had that happen before. Yeah.
Okay. It's in the contract. It was clearly an accident. What are we doing? Suspension. Okay.
But then it sat there for a week, right?
Typo.
To get it out.
Oh, then you got 3 days to get back. Yeah, it was great.
Kind of tying back into the theme of LOs and the transition piece. Jesse, what's been the biggest learning curve for you so far? And what has been the biggest breath of fresh air so far from switching to retail in the last 60 days?
I think the biggest learning curve is honestly the access to information. I've always been extraordinarily, that's not to flatter myself. I'm just a very resourceful, information seeking person. And that's always been a grind to kind of I'm going to go to the dark web and find the back way to this underwriter and this, that, but it's all there. And the transparency and the access to programs. And so I think that's part of it. It's a lot to learn. And I don't have a problem with that, but there's so much opportunity. And if you look at it as an opportunity instead of, oh man, you got to learn, I heard someone say, oh, then you got to learn all the lender systems. That's no, it's actually just the guidelines. And then multiple lenders do it, and some do have overlays, but then some have greater flexibility. So it's I don't know how that's a bad thing when you can literally if I could go to like, it's like Chipotle, right? Like you can either go order a burrito or you can go and order like, okay, I want extra chicken, give me double avocado and whatever. And like, it's kind of like custom making the loan that you need. So once you learn how to navigate that system, then like things start to go, oh. So like, I think it's the drinking from the fire hose piece that was, the most, it's not a negative at all. And then the biggest breath of fresh air is ironically probably the same thing. Just having all of that access. I was absolutely in a state of disbelief over a 5-day clear to close, like 100% guarantee this retired client would have needed to go provide like a divorce decree from 1993 and a 1099 from 2021 in a former environment. Like I was like, I mean, it made sense. It made perfect sense. And I was like looking at the stip sheet and there's like title, appraisal. Oh, like it's just the make sense conditions.
I was previously at a company that took 5 days for an initial underwrite.
Yeah.
Not a clear to close.
Yeah, right. So I think that's been the biggest, that truly probably is the biggest breath of fresh air where I'm like, want to like tell my other LO friends like, oh my gosh, like there's 2 conditions and that's how it should be. And that's how it came out. Like, yeah, that's been the most fun.
I love it. Love it. Love it. Love it.
Well,
so we're bumping up against
yeah.
an hour here. Do you, Craig, is there anything else you want to cover or any final comments? And then we can kind of shut this down.
Well, I think if anybody's interested in, looking into the broker side, I feel like now's the opportunity to make the switch. And I think that there's a lot of upside and I feel like there's a lot of scalability on the broker side that, the retail loan officers don't really understand because they're just not privy to this type of information. And I feel
want to throw one thing in there if I can. I'm totally cutting you off, but it's important. Who said this? Cody said this. I have concerns for my friends who, scattered across the country who are like starting their own broker shop basically because of a lot of the benefits we've talked about. That is probably, I would say, is one of my bigger ahas. Again, and I knew that from the research that I did, that it mattered who you aligned with and the nature of who you aligned with and the power of who you aligned with. But I think that that's a critically overlooked piece of the whole, like, I'm going to go broker because my rates are going to be better. Then what? What? And so that's a very different environment. Sorry to cut you off, but I think that was critical. If you're considering going broker, it's not just going broker. It's going to a place, whether it's here or somewhere else that has a similar offering. But that is so overlooked. And I have deep concerns for my friends who think that, because
it's easy.
A lender says we're going to help you get set up.
Yep. Yeah. I mean, coming from someone that tried it, I'd like to think I'm at least fairly intelligent. I can at least figure stuff out. And I spent a lot of time working through paperwork and legalities before I decided to come here.
Yep.
It is a lot. And if you're a full-time loan officer, it ain't. It ain't gonna work. It's a full-time job to do it. Yeah. It's a full-time gig.
And here's the thing is you can create that own environment no matter where you are production wise. You can have your own environment. You can have your own name on the door. If there's enough scale, it makes sense. You can do your own DBA. We can handle the paperwork, the legal compliance, the audits, the HR, the payroll, and someone can still then focus on building their business and growth. We're talking to a few opportunities just like that.
Yep. All right. Well, I think the show's over. We're at 59 minutes. So I appreciate Chris, the Messiah. Yeah. Thank you for joining the call today.
Like to thank my Lord and Savior Jesus Christ.
Oh God.
For showing up.
Cody, thanks for being on. Always a pleasure. Jesse, always bringing the heat. Love it. And then BW, thank you. Thank you for being a host.
Right on.
You guys have a kick butt day. Appreciate you guys.
All right. See you guys.
Thank you.
Bye.
Bye.